Welcome to the Value Investor TV podcast. Thank you guys for joining us. My name is Becco and my partner Hari.
How's it going?
This episode is episode 36, I believe. And in this episode, we will be talking about this company called WEX. This company came to our attention because one of our listeners suggested that we look into it. So this week we're going to cover WEX. So before we do that, Hari, can you give us a disclaimer?
Yeah, this is the Value Investor TV podcast. We are a podcast that helps you understand the concepts behind value investing. We are not financial advisors. We don't know your specific financial situation. So if you are about to make financial decisions or with tax implications, please consult with the appropriate advisor.
Great. Before we start digging into this company, let's just quickly make a few announcements regarding the checklist and the Slack message. Can you just walk us through that really quick, Hari?
Yeah, so, when we talk about an individual company, we actually look at that company with through the lens of a checklist, and that checklist contains information about how to evaluate a business based on some basic principles. What does the business do, moat, and so on. If you'd like to follow along with us, you can email us at info@valueinvestor.org, and we'll happy to send you that checklist. Also, we have a Slack community where you can communicate with us directly, get your questions answered, or chat with anybody else who's on. We have lots of people who are very active, and they can help answer questions or point you towards resources. Either way, we'd welcome your listenership, and anytime you have any questions, send us an email, info@valueinvestor.org.
Thank you, Hari. Great. So why don't we just dive right into it, Hari?
Yeah.
With our checklist.
Yeah. So the first question on the checklist is a pretty basic one. So what does WEX, the company, do?
Yeah. So I would like to take a quick moment to kind of walk you through what the company does. So off the bat, let me just give you a quick definition of how they define it. WEX is a global leader in payment solutions. That's how they define themselves in 10K. So what does that actually mean? They operate 3 different segments: fleet, travel, and corporate, and lastly, healthcare. So fleet is one, travel and corporate is second, and healthcare is the last. So what they do is, in basic terms, they are basically a payment solution company for fleet management and corporation. So what that means materially is, let's say you're running a fleet. Let's say you are a distributor of, let's say this tea right here, and you are supplying this tea to different grocery stores, for example, Safeway, and you have to manage the distribution of these tea to these different locations. So you have to have a fleet, actual physical trucks that will carry this tea to that respective location. And so when you're managing a fleet, a big part of that is managing the fuel, being able to maintain the business, doing regular updates. If part breaks down, you have to go fix it, things like that. And so when you have these sort of day-to-day problems, you have to be able to pay for these things. There are obviously, you can use corporate cards, but the big problem with that is there is a threat rather of misuse of corporate card, right? You can go out and use the corporate card for something else other than the core business. For example, you give out the corporate credit card to a driver, and the driver might actually use the card to fuel up not the company's truck, but his own truck, for example. And so tight management of that is really the crux of WEX's business. And so you enable this sort of tight control over the cost of maintaining fleet. That's the main fleet business. You have the travel and corporate in a very similar light. When you are booking travels or doing, having any sort of expenses related to corporate, the tight control over that expense, same kind of concept applies there, as well as healthcare. Let me give you a quick, a little bit more color on the company. They've been around since 1938, so been around the business for about 35 years. They are based out of Maine.
1983, not
Sorry,
38.
what did I say?
You said 38, but
38. That would be impressive.
yeah.
83. Yes. And they've been around the business for 35 years. They have a global footprint, based out of Maine, U.S., but they operate out of Europe, Australia, Canada, as well as New Zealand. Just a kind of high-level financial summary. As at the time of this recording, the market cap is around $10 billion. Per share is around 230. 2019 numbers, they booked $1.72 billion in revenue, gross income of $385 million, and net income of $155 million. So I'll stop there, and we can dive into these different segments as we see fit down the checklist.
Okay. So knowing that, the basic overview of this business, let's talk about what are the competitive advantages of a business such as this, and how does that competitive advantage fit into a particular category if there is one. So here are the we'll just go down the list. Do you think that they have a brand competitive advantage?
So I would say so. I would say so. So I think it's a weak one though. It's not really a strong one. If we do a quick thought experiment of if you're using WEX versus some other company, do you base your decision based on the brand? I would say no. It wouldn't be a strong moat. It might be. There might be something there, but I don't think it's a strong one, because at the end of the day, it's a payment solution. It's a payment solution company and solution, and as long as you get the job done, I don't think there is much there in terms of brand.
Okay. Let's talk about network effects. So, do you think that WEX has any network effects? And maybe we should define what that is if people don't know what it is first.
Yeah, network effect is the value of the product itself goes up with more users using the product. I think a classic example that people use to illustrate this powerful moat is Facebook. If only 2 people are on Facebook, the value of the product is not really useful. It's not really compelling. But if the whole world is on Facebook, it becomes that much more competitive. So that's kind of the summary of that. With WEX, I think it's. I don't think it's really a network effect. I'm having a hard time kind of categorizing this. Maybe I can get your help with this, Hari.
Yep.
So the main, I think couple really important kind of strategic positioning that they have done with the fleet, at least, is they are accepted. Their card is accepted at more than 90% of fueling sites. And so when you want to use the card, just like we talked about in the Visa episode, if you want to use Visa card, the merchants have to accept it, right?
Yep.
And so same way here, if WEX is not accepted at these gas stations or car repair shops, it's useless. So they've been around the block for about 35 years, so they have a lot of these relationships built out with fueling sites, so that when you as a customer join WEX ecosystem, you now have ability to fuel at 90 plus sites, or not 90 plus, 90% of fueling sites.
Well, I think that is a network effect moat. The other thing is that merchants have now an obligation to take it, because if somebody pulls up with their 18-wheeler and you don't take their card, well, then they're going to drive down to the next place and you lose business too, right? So, so there is a benefit there for having for both parties. So the more people that take WEX, the more people that are more business will be attracted, to there. More people will bring their fleet or their corporate business to them. So I think there is network effects there. But what we don't know about this, and this is where you'd have to, is how strong that is, because network effects can be very, very powerful if it crowds out any other sources, right? So the other thing that we haven't really talked about here is what are their competitors doing, right? If there are any competitors that offer the same service, do they have similar penetration into the market? In which case, their network effect benefit may disappear.
Yeah, I think that's the case with the current ecosystem. Unlike Visa or MasterCard, as we talked about in the Visa episode, where you have this 1,000-pound gorilla that is Visa, and then you have the MasterCard, and then you have American Express kind of on the side, where Visa is this dominant player. If you get on, you basically have unlimited access to all these different merchants. Therefore a huge, very strong network effect. In this case, I don't think it's as dominant as what you would see in Visa, and so that effect is a little is diminished. I would say substantially diminished in this world.
Okay. Okay. Well, I mean, we can talk a little bit more as we go through this with the network effect. But do you feel like once somebody signs up to WEX, is it hard for them to switch their corporate fleet into to a competitor? So what we call a switching cost moat.
Yeah. I would say there is some switching cost involved. And I would say the reason why I would say that is because another kind of a key value proposition of using something like WEX is that it's what they call closed loop system. So what that means is when you're using WEX card, for example, think about that 18-wheeler that you talked about, Hari, right? So a driver pulls up to a gas station, he pulls out WEX card, he punches in the driver's ID number to get authorized to purchase the fuel. You have to put in the mileage. You have to put in how much gas you're pumping. All these different information that you gather at the point of sale goes directly into WEX digital ecosystem infrastructure, and that information is available at the headquarter of the fleet headquarter, right? The fleet manager. And so from that perspective, if they build their processes around WEX and that intelligence that they get using the closed loop system, there is some stickiness there that you might find hard to replace with other companies.
Yeah, so that seems to be like a fairly solid moat for them, right? It's like Quicken or something like that, where you're, QuickBooks, one of these accounting services where, they're providing you a lot of data. They can give you reports. They can give you all of this stuff. For you to migrate wholesale from one, accounting software to another, or one, data analytics software to another, will require significant, training, require a lot of people. So it does sound like there's a switching cost there that could be fairly substantial, for a fleet, management business.
Yeah. I would say one more thing on that. I think we kind of hammered on the fleet segment, but we also have, as we mentioned up front, travel and corporate segment. And the idea is, as I mentioned earlier, it's very similar. And so they streamline the procurement process to pay for things such as the corporate travel, entertainment spending, automated clearinghouse, virtual cards, things of that sort, that it just really centralizes the travel and corporate expense for the headquarter, the company, the back office. And so, they've built around processes and these analytics tools on top. It would be a big, stickiness there also.
Okay. So it does sound like they've got it. Any comment about that with healthcare?
Yeah, similar to healthcare. You have They partner with employers, healthcare plans, third-party administrators, the payroll companies to administer, for example, Cobra. I think this is a good example where they come in and provide Cobra, administer Cobra. They also administer flex spending, health savings reimbursement accounts, all these other things that is kind of I don't want to say bedrock, but kind of a really important piece in managing companies. They provide these services to make these things very easy for the back office and the headquarter.
Okay. All right. Well, we have a couple more moats here that we can talk about. Low cost. Do you think that WEX has a low cost advantage over any competitor?
I think if at all, it'd be very minor. If I don't really have intelligence, honestly, on that specifically,
Okay.
whether they provide the lowest or not.
Well,
But I imagine it's going to be, if it is one, it's a minor one.
okay.
Um,
Well, I would imagine the company would call it out, like they called out the closed loop and that kind of
Yeah.
stuff. So,
yeah.
same thing with intangible assets. Anything there that you see, patents, copyright, trademark, software that that they trade secrets.
No, not in that. Not really in that sense.
Okay.
I think maybe a good example of intangible assets, like pharmaceutical companies,
Yeah.
where they have these, patented, protected, government protected, effectively a monopoly into that particular molecule.
Yeah.
That's not the case here.
Okay. All right. Let's move on from moats to talk about, what are the company's long-term prospects for growth, and I'm sorry, long-term prospects and runway for growth.
Yeah. Maybe I could start with talking about this string of acquisitions that they've made over the past 5 years, and then give a little bit more context into the long-term prospects. So if you look at their newest 10K, they talk at length about all the acquisitions that they've made. The one that I read in particular starts with 2014, July 2014 with Evolution, going all the way up to 2019, January, acquiring Discovery Benefit. And so I'll just give you a really quick snapshot. So Discovery Benefit, January 2019, $425 million. 2018, Chevron's existing customer portfolio for about $223 million. Noventis, electronic payment network focused on optimizing payment delivery for bills and invoices for commercial entity, $310 million. AOC, EFS, Benesense, UNIK, Evolution, and it's nicely spread out in terms of the business segments. So there's quite a bit in the healthcare space, administering Cobra, healthcare premium billing, Evolution, Benesense. There is Employee Benefit Administrator, the most recent acquisition, Discovery Benefit, and so on. So they've been really on a shopping spree, if you will, over the past 5 years to really increase their footprint. So just kind of a background on that. And we can talk about how they financed it and what the debt level looks like in the next question. But if you look at the revenue growth for the past 3 years, 5 years, 10 years, you're looking at about 14% growth. But if you look at the net income growth, it's kind of skewed on the higher end more recently. But overall, it's been about, I would say, on average, about 10, somewhere around 5 to 10% on average in terms of net income growth. And if you look at free cash flow growth, it's been about, for the past 4 years, about 7% growth. And so all that to say, it is growing, but some of these growth is coming from string of acquisitions that they've made, and there is some questions around the financial health of the company and the return on the capital that they've deployed to be able to pay for these debt. Yeah.
Okay. So, looking at that, and what we've talked about so far, we kind of get to a point where we look at the reinvestment into the business, in order to continue the growth. And so the way that we see that is, does the company require a lot of capital reinvestment to maintain its business, and can it grow without further reinvestment?
Yeah. So, maybe taking a step back from that question and just looking at the baseline EBIT, operating profitability ratio, and comparing that to other companies. So, right now, the most recent year, WEX have delivered about 22% blended rate, including all the three different segments, of about 22% operating profitability. If you compare that to Visa, which is sitting at around 50, and then direct competitor FleetCor, they're sitting at about 46%. And if you break out the operating income by three different segments, fleet, travel, corporate, and healthcare, it tells a more interesting picture. So fleet is standing at around 36%, travel, corporate 34%, and healthcare at around 3%. So you see a huge difference between the first two and then the healthcare segment, which is just teetering at around 3%, 3 to 4% in terms of operating margin,
which is pretty lousy, really.
It's very lousy. And if you actually look at the trend of what that looks like, so starting from 2015, so that's when kind of big acquisition happened in 2014 in terms of the healthcare space. It started at around 7.5% operating margin, and it stayed around there, 8%. It went up to 8% in 2016. 2017, it starts to dip to 6%, and then in 2018, it went down to what we just told you, 3.4%. So it's not only is it lousy, it's on a downward trajectory, which is of concern.
Okay. Well,
so yeah, go ahead, Ari.
Yeah, just looking at that though, is there anything that you can see from reading the report to say why? Well, to answer two questions, why is their operating margin lower than FleetCor, even in the direct competition line, of the fleet management? FleetCor is 46, they're 36. And then the second question, well, let's talk about that one first. Any answer for why FleetCor is so much more profitable?
Yeah, I think that's a complicated. I think it's a complicated question. I think we can break it out into several parts, but one that I've noticed, that's been kind of a glaring sign for me is if you look at the interest payment per revenue, you're talking about 7%. Now teetering at 8 to 7%. It went up to about 11% in 2016 of revenue going towards interest payment. And now this is not part of the EBIT, but I think this is an important one to mention, that the interest payment is now a substantial part of what goes out as an expense for this company. Yeah.
Okay, and then let's look at the healthcare segment. Any idea why it's been trending downward? Have they talked about that in the annual report?
Not so much. Not so much. I think this was something that I had to dig in to really find out.
Okay.
And so there wasn't anything that management really explicitly wrote out in the annual report. We're gonna talk about this in the next episode, but I imagine the management incentive is at play here. We'll talk about that in the next episode in terms of the the management incentive structure, what they're incentivized for, things like that. I'm sure some of that is at play here.
Okay. Let's move on, and one more question before we end the episode. Looking at the relationships that the company has with various parties, do you see any red flags with any of these? So the customers would be the first relationship. Is there any red flags or any problems with their relationships with customers? Or does any one customer present a large percentage of their revenue?
Yeah, I think you nailed it. The latter. I don't think it's as skewed as some companies that I've seen in the past.
Mm-hmm.
For example, some companies that I've seen in the past, like good majority comes from one single customer. I mean, that's a bad sign right there.
Yep.
It's not as bad, but top 5 customers account for 13% of revenue.
Okay.
So it's not bad, but it is something to keep an eye on.
Okay. Any issues that you see with suppliers, employees, or regulators?
Not so much in terms of suppliers. I think this question really more applies to more manufacturing kind of space. So not really here. In terms of employee, regulator, community, nothing really outstanding. One thing I will say about regulators is that they have mentioned in the annual report, especially in Europe, they're getting scrutinized. I guess not just them, but the entire industry, financial services industry. They're getting scrutinized for the fees that they charge.
Okay.
So that's something to keep in mind. And there might be some sort of downward pressure in terms of how much money they can charge because regulators are cracking down on them.
Okay. Well, I think that's a good place for us to stop. And in the next episode, we'll be talking more about the management structure, the valuation of the business, and its cash flow and so on. So, anything else that you want to add about this company before we move on, Becco?
Not particularly to this company, but I will say just, as a value investor, I think one of the joy of being a value investor is that you get to understand these companies, understand these industries, right?
Yep.
Like before I looked at this company, full disclosure, I am a total novice into this industry. Like I had no idea this sort of industry existed. I used cards, something like this, when I drove, what's that company? Zipcar. Like Zipcar has something quite similar where when you're part of the member of Zipcar community, you can get on these cars and fuel is included in that membership. And because of that, they give you a little card where you can use that card to fuel your rented vehicle. So I have some familiarity with this, but nothing like I have now. Having analyzed this company, so I would make one comment on that, and the other comment I would make is just the breadth and the depth of the American capitalism and the market. I mean, we're talking about a company that's $10 billion in market cap, over $10 billion in market cap, and I am sitting here in San Francisco, Hari, you're in Houston. And these are sort of major economic centers. In San Francisco, there's a lot of tech companies. In Houston, a lot of oil and gas companies. But this company is based out of Maine. They have $10 billion market cap. Imagine just the entire continental U.S. Imagine how many of these companies there are. I mean, to me, that's just pretty astounding. Just to be, just to know that these companies are available to understand and potentially to invest in.
Yeah. It is pretty amazing to think about sometimes because you don't really realize how much of, this company, the tea that you're drinking or the food that you're eating is probably managed by their payment is fleet management is done by a company like this. So how many things affect you on a daily basis that you have no idea about. So
yeah.
Okay.
Pretty astounding.
Well, let's call it a day there, and then we'll see you guys on the next episode.
Thanks, guys.
All right. Thanks.